Welcome back. Well, let's talk about some market action then. Anuj Singhal and Sonia Shenoy caught up with fund managers to gauge how they approach the market in the run-up to the big elections. Listen in to an excerpt of that conversation.
We did see much higher teaser of SIPs on a direct side compared to SIPs sold by distributors. We also saw more redemptions on direct investments compared to investments brought by distributors. So somewhere there is this 100,000 plus feet on the street which are talking to investors, talking to retailers, giving them shoulder to cry upon when markets are down. And that hand-holding has resulted into tenacity of this flow. My presumption is that this flow should continue.
Okay, the presumption is that the flow should continue. We've actually done a little bit of an analysis on how the markets have fared in the last 3 terms. So if you look at between May 2014 to the present situation, it's about a 10% compounded annual growth rate that we've seen in the market over the 5 years. May 2009 to 14 is a 10% growth rate, and before that, May 2004 to 2009 was a 25% growth rate. Sunil, coming to you, does this election have a potential to derail the market either way, or do you think it's going to be a non-event from a market standpoint?
See, as you rightly pointed out, that last 3 terms we have had varied I would say results from the elections. Ultimately, on the day of the election results, markets have swung very widely, but over a period of 2, 3, 5 years, I think the returns are just mirroring the GDP growth. So yes, on the day of the elections, depending on what surprises the elections throw up, there's going to be definitely a knee-jerk reaction. But I think history has proven over the last 9-10 terms that the markets are behaving in sync with what the GDP growth is. So I would say that the day of the elections might be up and down, but eventually it's the economic cycle which takes precedence. Obviously the market wants a particular party to win, so that would be a near-term sort of a kicker. But I think over a period of time you have to take into account a 7-8% GDP growth, a 4% nominal growth, so the broad markets to go at 11-12%.
Navneet, do you agree with that view? On election day, 1 week after election, 1 month after election, it's a different case altogether. Of course, post 2004 we had down circuit in the market. After 2009 we had an up circuit in the market, and then the returns have been pretty much, as Sunil said, on a linear manner, tracking the GDP growth or the earnings growth. You think 2024 market would be where it should be regardless of who comes to the power, or is it going to make too much difference if Mr. Modi comes back or not?
So Sunil said that market definitely expects a certain leadership and a certain government. Having said that, if you look at the history over the last 25 years, since 1991 when we started the liberalization, India has been growing at 7%. You add so far the inflation has been higher and nominal GDP growth of 12-13%. Corporate profits have grown at 14-15%, and market has delivered exactly the same return, around 15 or 16%. An interesting aspect, several times when we look at the stock market return in a particular regime, we also forego maybe something may have happened before that or after that, because markets are forward looking.
Yes.
So if I compare the 2003 to 8 period where economy grew at 10%, 9%, and markets delivered phenomenal returns, 2 or 3 things very briefly I'll mention. We had substantial investments in road, telecom and electricity. Something similar has happened this time. We had significant decline in inflation, which led to lower interest rate regime in India from double-digit rates to 5-6%. Something similar is likely to happen because inflation has come down. But a significant cleaning of the bank's balance sheet. Exactly same thing has happened. Over the next few years, banks are prepared for a new credit cycle. And then the capital markets helped you. And that's when the corporate India could raise money both in the equity and the debt market. And then we had a good period. The only difference this time is the global environment may not be as bullish or as supportive as we had in 2004 to 8. But otherwise, if I look at next 5 years, I think the structural growth story continues and cyclical upturn. We are going through a cyclical slowdown today. Nobody expected this kind of cyclical slowdown, but I think the cyclical upturn is likely to come from second half of this year.
Is there a bit of a spillover risk now for debt mutual fund because of what has happened? I take your point that you are paying, but this is creating some kind of uncertainty. This whole Z issue, ITNL issue, how much of this is going to come back? Is this going to create one more round of liquidity issue, especially around debt funds?
Anuj, the liquidity issue originates from the systematic liquidity, never from market liquidity. If there is rain, then there will be water in the lake. If there is no rain, there is no water in the lake. So lake's water is dependent upon the rain. If there is systematic liquidity surplus, markets will be liquid. If the systematic liquidity is deficiency, then markets will be illiquid. Your FX interventions, your currency in circulation increase takes away liquidity. That is compensated by open market operations. Now if that amount is negative, the markets will be illiquid because there is no systematic liquidity. Second thing is related to credit side. Now 90-95% of mutual fund assets are onto funds which are AAA rated. Now of course within AAA sometimes ILFS could happen, but ILFS was held by 6 out of 44 mutual funds, not by all 44 mutual funds. Majority of mutual fund also had ILFS exposure in their credit risk funds, not necessarily in non-credit risk funds. Now in credit risk funds you are bound to take credit risk and it might result into some delay, some defaults. But rest of the funds like bond fund, gilt funds, short-term funds, liquid funds,